Thanks very much for inviting me to be here. It's really great to be here. This is joint work with my colleague, Josh Hortstein, he's a behavioral theorist. And actually, I'm very excited to do this here because we've been working on this agenda for a couple of years, but I've never actually done it in front of a finance audience. We've mostly done it in front of behavioral audiences. So the sort of starting point for the agenda is that this observation that when you're thinking about like, what's the role of groups in financial markets or groups in economics, we often default to thinking that there's sort of an information or data role. So, why have a committee? The committee aggregates information across people. Why have a corporate board? What's the role of an investment committee? What does a financial advisor do? Standard theories in economics would say it's all about information provision. And once you have that view that it's all about information provision, well, then generally information provision and aggregation is going to be helpful, right? So having a committee that aggregates over many private signals is going to get you closer to the truth. And because we're getting closer to the truth, that's going to tend to make people better off on average. And sort of a corollary of this is that, there's a very strong notion that the marketplace of ideas or the wisdom of the crowds is very strong. Okay? So like more people, more information, better outcomes. And there's certainly, many true aspects to that view. What we're trying to do is just put forward a sort of different view of what's going on when you have groups or committees. And we think that this is like an important thing that sometimes is missed in the economic approach. So we want to sort of take as given the data is fixed, but we want to think about talking about how the data is interpreted. Okay. And so that's going to be sort of the focus of what we do. So like, what's the role of a committee? Well, different people on the committee, they're looking at the same data, but they're going to have different interpretations of it. And so in the first paper we wrote on this topic, it was sort of a strategic setting. So there's one persuader. I'm a financial advisor. I'm trying to persuade you to keep investing in this mutual fund that's had low returns. And so we're both looking at the return data. What can I persuade you of in terms of what the mutual fund sort of forward-looking returns would be? That was the first paper. And so this paper that I'm going to do today is thinking more about non-strategic or social exchange of interpretations. Okay, so the idea is just like, what happens at a water cooler when you're like trying to explain to your colleagues, like, well, sales were down. Everybody has a different theory of why sales were down. It's not really information aggregation so much as just trying to interpret the same data in different ways. Okay, and so the goal sort of is to think about, in some level, like, why are there so many mistaken beliefs in finance and financial settings? Well, one reason is that, and those beliefs persist. Well, one reason is that people actually, like, they think they have interpretations of the data that they find compelling that lead to those beliefs. Okay, and so that's what we're going to try to think about. Here's just a silly sort of illustration. Like, everybody has seen, cartoons like this. So it's the same set of dots. If I draw a line through it one way, you get a very bullish interpretation that this thing is going up. If I draw a line through it the other way, you get the sort of bearish interpretation that it's tailing off. This is obviously just a cartoon, but there are, financial settings where people actually do this. The most obvious one, I think, would be technical analysis. So this is from a technical analysis board where people exchange their different technical analyses. And so the two figures, it's a little hard to see, but the two figures are the exact same price path of Amazon over like the last month. And on the left, you have a person saying, this is a classic support resistance pattern. We've hit the resistance, and so you should buy. And on the right, you have another person looking at the exact same price path saying, this is a classic head and shoulders, and therefore you should sell. Right? And so this is, of course, we don't think many very sophisticated people do this, but lots of retail investors do lots of stuff like this. Right? And if you just think about sort of stuff that's more, in the media or in the news, you do hear these kind of things all the time, right? So you hear, this time is different. What is this time is different sort of concretely saying? It's saying only look at recent data, don't look at data that's far back in the past, because the data that's far back in the past is irrelevant. Inflation's transitory is sort of the opposite. It says don't look at the recent data because it's sort of irrelevant to what's going to happen in the future. Right? So, and then, if you ever listen to like a VC investment committee or something, they will say these things like, of course, those committees do try to discover information, but they also will say things like, we just put a lot more weight on the team than the product. And that's a view on which parts of the data are really relevant. What we're going to try to do is think about this sort of group exchanges of interpretations or models, and we're going to sort of ask three questions. Like, does it push towards the truth? Does it tend to resolve disagreement? And then sort of fundamentally, which interpretations are most likely to spread among a group? Okay. A little bit of setup. I will try to not do too much algebra, but so you're going to think of like there's a state of the world, like, the firm's good or bad. And we're uncertain about the state, and we have some data. Okay. And then we need a model to interpret that data to help us update our beliefs about that state. So formally, what we're going to do is we're going to say models are likelihood functions. So remember what a likelihood function is it tells you, given your prior beliefs about the state, how likely is the data? And then what you do with Bayes' rule is once you select a model, a likelihood function you like, you use Bayes' rule and you flip it around and you say, well, given the data, how should I update my beliefs about the state? And so that's our little modeling device, is that we're going to think of models or interpretations as likelihood functions. We're not going to allow people to influence the data at all, just to make it stark that this is really about models and not data. And then there's sort of two constraints on which model gets adopted. First, there's sort of a more exogenous, I'll call it, constraint on just there's certain models maybe that you're not allowed, but no one will entertain. In many of our results, we will just think about there being all models are entertained, but sometimes we'll do more restricted model spaces. The second thing is more substantive is, for a person to actually adopt a model, we're going to say they need to find it compelling. And then we're going to have a very particular definition of compelling. Okay, so our definition of compelling is essentially going to be sort of like a maximum likelihood type of intuition. So we're going to say people like models that fit the data well. Okay, so if you're a frequentist like me, you're like, I like high R-squareds. If you're a real Bayesian like Josh, you're like, I'm going to compute the probability of the data given a likelihood function and my prior beliefs. And that's that equation down here, is that for any model m tilde, there's a sort of likelihood function that goes with it, pi of m tilde. Then I take mu naught of omega is my prior over the distribution of states omega. And so I sort of integrate the likelihood of the data that I observe, which is h, over every possible state given weights from my prior mu naught. So that's saying, given my prior and this model, how likely do I think the data will? Okay, and so it's a behavioral assumption that people like models that explain the data well, and that's sort of our key behavioral assumption. This is also, it's actually quite close to what a Bayesian model averager would do. The key thing here, though, is that you're not exposed to all models. You don't sort of start with the right prior overall models, which are Bayesian. Okay, so that's sort of the key difference between what we're doing and what a Bayesian would do. A Bayesian also likes good fits. They're just putting a little bit more structure on the problem than we are. Yep. And there's a lot of literature in psychology that sort of says like this kind of assumption is not crazy. It's plausible. People do seem to like, explanations that have quote unquote high fidelity to the data or have a lot of explanatory time. Yep. So why is this? And this assumption is basically going to drive everything. Okay, so what this assumption does is it sets up an interesting trade-off for a person who's providing you with a model, which is that we're saying that to get you to adopt the model has to fit the data well. But a sort of interesting sort of implication of Bayes' rule is that if a model fits really well, what does that mean? It means that the data are not that actually surprising. What does that mean? It means that your prior sort of told you to expect this data. What does that mean? It means that you shouldn't really update your beliefs very much. Okay? And so models that fit really well, on average, are going to tell you you don't need to move your beliefs very much. So if I wanted to move your beliefs a lot, I can't give you a very good fitting model. But in order to get you to adopt the model, I sort of have to give you a pretty good one. Okay, so that's sort of going to be a key intuition that runs through the whole thing. Okay, so that's sort of like the single single agent setup. How are we going to think about groups? So now we're going to say, there's a group of people before seeing the data. Everyone sort of has one model. They start with one same model for interpreting the data. Then after seeing the data, people can come up with their own models. It's like, again, I woke up and sales were really low. I decide it's about, our workforce is unmotivated. You decide it's about, we set prices too high. So each person can come up with a different model, and then you're going to exchange models with people in your network. And then what ends up happening within network is everyone's going to go with the model, or is going to choose the model that they're exposed to through the network that has the best fit. So that's, again, the best fit criteria. Okay. And that's the setup. Here's just an example. Basically, I think spend most of my time on this example to work through it. So very simple. There's just two states. The company is either good or bad. And let's say that there's a bullish group of investors. Okay. So their prior is that the company is good with probability 75%. Their prior that the probability is bad, that the company is bad, is only 25%. Okay. Now suppose the data comes out that it says, the firm's earnings were low this quarter and the economy entered a recession, which, could actually be today. So the true, if we knew the true model would say that low earnings are a bad signal of fundamentals. So the conditional probability, so MT here is the true model. The conditional probability of low earnings given bad is 75%, while the conditional probability of low earnings given good is 25%. So in fact, this is an informative signal. You should update when you see low earnings that the firm is bad. And in this way I've set up the true model, I've just assumed that the aggregate economy is actually irrelevant for the way you update about the firm's fundamentals. Okay, so what you should do if you need the true model is you just do Bayes' rule with your prior and this likelihood function, and you should update to think, well, now I think the probability that the firm is good is only 50% instead of 75% because I got this bad signal. Okay? But suppose I say, you're not restricted to only use the true likelihood function to update. What other things might you do? What other models might you come up with? So here's a few different kinds of models you could come up with. One is what I'd call the Buffett model. There's this famous Warren Buffett quote that only when the tide goes out do you discover who's been swimming naked. So how do I make that into algebra? One way to say is well, what Buffett's saying is that actually low earnings are a particularly negative sign about the state of the company in a recession. And so that means that the probability of low earnings and a recession when you're bad is substantially higher than the probability of low earnings and a recession conditional on good. So that's sort of a Buffett model. Another thing you might hear people say is that, well, in a recession, everybody's earnings are down. So earnings are sort of not that informative in a recession. And that would just sort of say, well, now the probability of low earnings and recession given bad is the same as the probability of low earnings and recession given good. So that's another model. It's just we shouldn't ignore this data. It's not that useful. A third model that's sort of related to that second model is low earnings are actually inevitable in a recession. All companies of this form will always have low earnings in this recession. And so then there's just one more. This is the same condition as above. So, probability given bad is the same as probability given good. But now it's anytime there's a recession, that's what you get. And so those are different models that people could propose, having seen this data. Now, what's actually going to go viral under our assumption that people like good fits? It's actually the always low in a recession model. Okay, that goes viral. That is that's the model that has the best fit of the data. And interestingly, it it implies that you shouldn't move from your prior probability, okay? Because there was nothing to learn. These companies always have low earnings in a recession. There was nothing to learn about whether the company was bad or good, and so you should sort of stick with your prior. Okay? And so again, that's like this fit versus movement trade-off that I talked about before. That's what's driving this here. So like people like good fits. Good fits say the data is not surprising, and if the data is not surprising, you shouldn't update, and your posterior belief should be pretty close to your prior. Okay? Other implications that come out of this: one, conspiratorial quote unquote models will tend to win. So this model that earnings are always low in a recession is conspiratorial in the sense that it's taking some sort of low probability event like a recession, and it's linking that recession to the other piece of data, the earnings, and that's how it's explaining things away. And so bringing in other pieces of data that are actually irrelevant, our model sort of predicts, or our framework predicts that's a likely thing to happen, because once you have these irrelevant pieces of data, you can sort of say, well, of course X was inevitable given Y, or of course you should expect that McDonald's should have had low earnings this morning because egg prices are high. You shouldn't learn anything about McDonald's management or operations or anything. So those are the types of models or interpretations that tend to win. And in fact, in the paper, we show that for a particular formalization of what it means to be maximally conspiratorial, investors in our framework end up holding the sort of maximally conspiratorial model. And so that's sort of implication one. Implication two is sort of it's basically by assumption. So it's I don't want to oversell it here, but we say that sort of social learning hardens reactions to data, meaning that after you've gone through this exchange of models with other people in your network, you have a better explanation of the data than you did before. Again, that just comes directly from the fact that I assume that you like good fits. Once you've been exposed to a bunch of models, because you've been exposed to a bunch of models, the fit of the model you choose sort of has to be higher than it was before. I think one sort of interesting implication of that is there are investors who I could have persuaded them of the truth if they hadn't been exposed to all the other models. Okay, so but once you are convinced there's nothing to learn from the data, it's really hard for me to talk you out of it. But before you've been exposed to, like, here's the reason you don't really need to update, I can actually probably convince you of the truth that the company's bad, or that the probability that the company's bad is higher. Implication three, which again we saw, is that social learning tends to mute reactions to the data. So there is something that if I knew the right model and updated rationally, the data would cause my beliefs to move. In this case, I would have gotten less optimistic about the company. But because there's an explanation that says you shouldn't learn that much from the data, my beliefs tend to move less in response to the data. And so here I had set it up as, people are initially pretty optimistic on the firm. If you thought there was also a network of people who were pretty pessimistic on the firm, sort of the same thing would happen. They would sort of first say, like, aha, this is great news that we should be even more pessimistic about the firm. But in our framework, they then go back and say, like, well, let's not go too far. Okay, like, actually, this is probably a one-off too, but I remain as pessimistic as I was before. Okay. And then, again, like a sort of last implication of this is that as you exchange interpretations or models, you can actually push people off the truth, right? If there were people who started with the true model actually does not fit as well as the there's nothing to learn here model. And so you can, like, here the marketplace of ideas, the way we set it up, doesn't actually necessarily push you in the right direction. Okay. So that's sort of just the theory at a very high level. I thought, especially in this audience, I've kind of done this fun empirical exercise from StockTwits. I would not call it, this is not a well-identified anything, but I think it's just illustrative. So StockTwits is, if for those of you who don't know, is like Twitter, but for stock recommendations. And so Tony Cookson and Joey Engelberg and Marina Niesner have written a bunch of papers on this. What's cool about it is users they tag their messages with individual stock tickers, which are called cash tags. And they also label, it's good marketing. They also label their messages with either a flag saying I'm either a bull or a bear on this stock. And so a cool fact that Tony and I think Joey showed in one of their papers using this data is that you do actually tend to form sort of, homophilic groups. So like if I'm bullish on Tesla, I tend to follow other people who are bullish on Tesla. And I actually get that behavior gets stronger after there's news about Tesla. So it's like, I'm a Tesla bull, something happens, and now I'm like, I really need more analysis of Tesla from the other stock tweeters. So that's sort of fact one. And then fact two, which is what I'll show you, is that actually this kind of idea of, I think there's probably other interpretations, but this idea that like after news happens, people respond and then come back to your prior, that looks like it's true in this data. Okay. So here, just to give you a sense, so this is Palantir, a couple of years ago had a pretty negative earnings surprise. The stock fell 5%. And here's Moo, who's quite bullish on Palantir. And he says, well, even if the revenue growth's a little bit lower than we thought before, the multiple's still way too low. It's cheap on a multiple basis. You should buy. Okay. Now, if you go and look at who Moo is, he's Mike Savvy, and he follows another thing called Val Investment Fund. Is that you? And Val Investment Fund is also a bull on Palantir, but he's now doing a technical analysis argument. He's saying there's resistance at 29. If you don't sell below 29, hold your line, and buyers will come in, and we'll make a 10% gain today. Yep. And so, again, like what the Cookson paper showed is that this behavior that the bulls follow the bulls and the bears follow the bears, that's pretty systematic. So that's what this graph shows, is that, if I'm a bull, the fraction of people, the probability that the next person I follow is a bull is that dark line, versus a bear is the dash line, and then the bears are the opposite. Okay. So that's these people are sort of like getting into groups where they can exchange interpretations with like-minded people. And then this is the sort of thing we did, which is let's look at people who were bulls on this stock before. Okay? So, and then let's look in a 10-day window around earnings surprises. So the blue line is if the earnings surprise turns out to be positive, the bulls basically don't do anything. They just remain bullish. Okay? The green line is what happens when there's a negative earnings surprise. So one, there does seem to be like a little bit of leakage, like people are getting a little nervous beforehand. But two, sort of after the price, after the earnings announcement, sentiment drops pretty rapidly and then reverts. And, one thing that's not in this picture, but it doesn't actually look like this is just driven by like prices moving around. So if you control for how big the price movement is after the earnings announcement, that you get the sort of same picture. But again, like it's just meant as like sort of suggestive that something like, in our framework, the way you would explain this is you'd say, well, what's happening is that after a negative announcement, the bulls get sad, but then they start talking themselves into like the negative earnings announcement wasn't such a big deal. Right? And then the same thing is actually true of the bears in reverse. So in bears, if there's a positive announcement, they tend to get more bullish for a little while, but then go back. Okay? So that's mostly what I wanted to cover. So the idea we're sort of interested in is that sharing of models across networks can help explain persistent disagreement. So like when you're a bull and you get bad news, you're going to exchange a bunch of explanations with your bull friends for why you shouldn't pay that much attention to the data. The bears are doing the same thing. They're exchanging interpretations that say, you should ignore that positive news that GameStop had. Let's stay bearish. And so this is sort of an explanation for why you can get sort of persistent disagreement, even when you'd say, well, shouldn't the release of information sort of on average push towards less disagreement? This is sort of a force that would go in the other direction. So in the paper, we do a bunch of other stuff, like, asking like what happens when the bulls talk to the bears, and talking about sort of communication strategies. So, one thing that happens in our setting is that there is sort of a rationale for getting ahead and spinning the news before everyone else, because then you can sort of control, how interested people are in talking to other people to figure it out and which groups they talk to. So thanks a lot. I'm looking forward to Philip's comments.
Okay, so we now have Philip Braun discussing the paper from the Foster School of Business.
So it's about agents who are forming beliefs in a non-Bayesian way. They do this in groups. When agents form groups, often we fear that there's going to be some sort of echo chamber where the agents inside the group talk themselves into the most crazy belief. And the paper presents a result that I would say is basically an anti-echo chamber, anti-radicalization result, which is that contrary to what we might fear, and we certainly spend a lot of time talking about this, sort of outside economics, it's not the most crazy belief within the group that wins. It's actually in some ways the most reasonable belief in the group that wins. Okay, so that's sort of a high level overview of the paper, and I'll spend a little bit of time going through where these results come from. So what I want to do in my discussion is I'm going to sort of go over what I've called this anti-echo chamber result. I think this framework is very rich. So, I think it's, the economic force behind this anti-echo chamber result makes a lot of sense once you understand it. And Adi did a great job explaining it. I'm going to sort of say it a second time as well. But the framework is sufficiently rich that I think actually quite small perturbations of this framework also give you things that are going to look more like the echo chamber result you might have been expecting. So I'll show you that. And again, this is not my goal here is not to sort of say that these guys got it wrong, more to sort of emphasize that the framework really is a rich framework and you can perturb it very slightly and get things which I think are in themselves quite interesting. So that's the basic plan. So before I do any of that, let's just sort of take a step back. So what is this paper doing? So this paper is taking, we have agents there's some unobserved state omega, and ultimately the agents are trying to learn about this unobserved state omega. In Adi's example, this was the firm good or bad. They have some prior, U0, they see some history H, and they're looking to update their beliefs about the unobserved state omega. Okay, so that's what they're doing. So how do they do that? So they're going to form the posterior using Bayes' rule. So there's Bayes' rule. And the only reason, you guys know what Bayes' rule is. The only reason I've written out Bayes' rule is to emphasize that the key object in computing Bayes' rule is this. You need to assess what was the probability of seeing some particular history given the underlying state omega. And that's what Adi calls the model, right? That's the model of the world. And so we want to think about this as being the model. This is just a conditional probability of what's the probability of seeing some particular history given some state of the world. Now, obviously the difficult thing, right? So you can write this down, but obviously as soon as we think about this, we confront the idea that we actually don't really know what the model of the world is. And there's been some significant literature on this issue of like, how do we deal with model uncertainty? So, we can do a variety of things. So it's for a long, long time, we said, well, it really doesn't matter because what you should do is just this. You should just take expectations over all the various models of the world you might have, and it's just going to work out as if I have some average probability. So that would be the traditional thing to do. There's obviously been some, over the last 20, 30 years, there's been sort of a different strand of literature, so perhaps most associated with Gilboa, Schmeidler, and Hansen and Sargent, where we tie this to a specific decision problem and we do some version of ambiguity version of robust control, where we focus on sort of what's the model of the world which is going to sort of be most dangerous to me to adopt, and I should really be focusing on that. Or we can do something like Adi and Josh have done in their previous paper and the one today, which is, so I would describe this as we're going to have like a semi-dogmatic attachment to a particular model. But it's not going to be completely dogmatic because I am going to be open to switching to another model under the conditions that I'll show you in a second. Okay? So I'm going to, but this is how this paper fits at a very high level interpolation. Let me just emphasize, and this is as much for my benefit as for yours, that because I often when reading the paper I found myself losing track of this, that the goal of agents in this model is really to form beliefs about the underlying state omega. And models, this talk about models is in the title, but really this is agents trying to form beliefs about omega. And the models are just a device for doing that. Now the models do provide some potential additional empirical moment that we could directly try to measure and target. But fundamentally you want to bear in mind that this is agents are trying to form beliefs about the underlying state. And again, I say this just because I find myself getting lost on that point indication. Okay, so I think it's going to be easiest if I go through this by means of an example. It's not quite going to be this example, but it's actually going to be sort of reasonably close. I'm going to change the labels. Okay, so I'm gonna have agents try to learn about, in this case, whether the FDA is trustworthy or untrustworthy. And following Adi, I'm going to label these views left and right, or L and R. You can blame Adi for these labels if you don't like. We're going to have agents entering with a flap prior, so they think these two things are equally likely. They're going to see some history, right? The back should before I sort of the history, the background environment here, which should be easy for us to imagine, is there's some widespread disease in society, and we have a friend who gets vaccinated. And the history I'm going to see is, unfortunately, the friend is either alive or dead. And we're going to try to update based on whether our vaccinated friend is alive or dead. There's going to be some default model, and I'm going to follow the paper and assuming the default model is actually the true model, and the default model is that if the FDA is trustworthy, then this vaccine we're getting is actually very effective. On the other hand, if the FDA is untrustworthy, then the vaccine is in fact worthless. Okay, so this is if the vaccine, if the FDA is trustworthy, then the friend takes the vaccine and is alive with high probability. If the vaccine is worthless, then the friend who gets vaccinated is alive with much smaller probability. Okay, so that's the model. And again, I'm going to follow, and this is really this interpretation. I'm going to follow Adi and assume the default model is the true model, and on top of that, I'm going to assume that the true state is actually that the FDA is trustworthy. This is really just interpretation, but it's going to be useful because the thing we fear here is that people are going to end up with the wrong belief. So what's the wrong belief here? The thing we fear is that people are going to end up believing the FDA is untrustworthy. And so it's useful to start from this interpretation. Notice that I obviously picked not a very financy example. So just as a second aside, in what sense is this paper? Why is this paper on the program today? My general view of this is, beliefs matter in much of economics, but they really, really matter in financial economics. So, I think in financial economics, it's very important for us to understand belief formation, and we should think about this paper as being part of that general enterprise of understanding belief formation. Okay, so back to my example. So this is just reminding us what the default true model is. So let's think about an agent who we'll call Iggy. Observes this history. The good news is the friend is alive. Okay, so we can see what the probability is of this event under the default model, right? This is just remember that if the FDA is trustworthy, then the friend is alive was a 90% probability event. If the FDA is untrustworthy, it was a 50% probability event. And so the default model yields the history which is observed with probability 70%. The problem is that there are lots of other models out there, quite mistaken models, that are going to yield a higher probability of that same outcome. So here's one such model. This is what the paper calls Iggy's initial reaction. So somehow Iggy forms this different model. This is one quite far from the truth. This is if the FDA is trustworthy, then the vaccine just isn't that effective. And if the FDA is untrustworthy, that means they've been lying to us about the disease, and really the disease hardly kills anyone at all, and the survival rate is just 0.9. So this model, notice, we can compute the probability of our friend being alive under this model, and it's higher. It's 0.75. And so what happens in the model, what happens in rather Adi and Josh's analysis is this means that Iggy is going to update to this new and incorrect model because it produces a high probability of seeing the observed history. And then using this model, we can form a posterior, and this model, right? Because in particular the event that really leaves the friend alive is that the FDA was untrustworthy. This is going to move our beliefs against the FDA being trustworthy. Our probability that the FDA is trustworthy drops now from our prior of 0.5 to the posterior of 0.4. So this is not a useful model to have adopted. Okay. So now let's do social learning. So far this is just our initial reaction to it. Let's do social learning now. So social learning is that Iggy, having already messed up by adopting this not great model, meets Jordan, and Jordan has an even worse model. Right? Jordan thinks the vaccine efficacy is even lower, and the disease is even more fake than Iggy's initial reaction. Now, the problem is this is an even more attractive model, right? So we can, again, work out the probability of seeing our friend alive under this model, and it's even higher than under Iggy's already messed up model. And so under social learning, Iggy is going to want to adopt this model, and that's going to yield an even lower posterior. Now the probability that the FDA is trustworthy is down all the way to 1/3. So this is sort of what we might fear is happening, right? This is social learning. I already sort of mistakenly messed up and convinced myself of something of a not so great model. Now I run into this guy with an even crazier model, but the crazier model explains the data even better. I adopt it, and my beliefs end up being even worse. Okay. And let me just point out and sort of and he mentioned this. A nice feature of this, and this is really a result in his previous paper, and a virtue of reading this paper was I went back and read Adi's previous paper too, is notice that although the class of models is sort of arbitrarily large for much of the analysis, that doesn't mean the posteriors are arbitrary, because notice that the way I've set this up, this guy Jordan's model is the worst possible model that E could come across. What do I mean by that? Well, if we made this number lower, if we made this 0.5 number any lower, then the model would not explain the data well enough. In particular, it would predict too high. If the beliefs about the vaccine were even worse, then he wouldn't find a persuasive explanation for why his friend was still alive, and so he wouldn't adopt it. On the other hand, if this probability were higher, then Iggy would adopt that model, but it would lead to less updating, and it would mess up Iggy's beliefs less. Okay, so this is actually the worst possible model for Iggy to confront the data, and this is really like a nice result from Adi's previous paper. Okay, so I'm now ready to sort of go to this, what I call this anti-echo chamber result. So again, the anti-echo chamber result is, I've just set this up where social learning seems sort of threatening, but it turns out actually not to be threatening. So why is it not threatening? It's not threatening because I'm just going to have us forming beliefs based on what our posterior beliefs are after our initial reaction. So in my example, we're going to have a community of people who are all pretty skeptical in the FDA. Everyone's agreed that the probability that the FDA is trustworthy is at most 45%. So there's some baseline level of skepticism in this community. But somewhere in this community is a guy called Kingsley, and Kingsley has this model, right? So Kingsley's model is basically, it doesn't matter whether the FDA is trustworthy or not. Either way, the friend is going to be alive, right? So why is that? Well, if the FDA is trustworthy, the vaccine efficacy is high. On the other hand, if the FDA is untrustworthy, the disease is completely fake. So this is sort of, you can see this is the almost no updating model. If you come across this model, because it doesn't matter which stage you're in, the friend explains the friend being alive, you basically don't update at all. And the only reason I haven't made this one is because I need to have the friend live in this community of people who are skeptical about the FDA. And so this model explains the data very well. It explains why the friend is alive. And so it's a very attractive model to adopt. And so it indeed gets adopted. But it also means that we just don't really update very much from the data. And so in particular, I end up within this community of people who are skeptical about the FDA, perhaps surprisingly, the belief that wins is the most positive belief about the FDA within that sort of baseline level of skepticism. So this is what I'd call the anti-echo chamber result. Okay. So far so good. Okay, so this is what I'd call the anti-echo chamber result. Okay. And again, this is a nice result. It makes sort of sense once you've sort of worked through this. I had not seen this particularly coming, but again, it's basically this. The attractive model is one that overfits the data, but the one that overfits the data leads to not much updating, and that's why we end up that's why we end up avoiding the worst case belief. Now, what I found interesting as I worked through this is to realize that there were relatively small perturbations we can make to this that actually are going to give things which I think are interesting in their own right, and which are going to look much more like an echo chamber result, or maybe even more surprisingly, there's going to be a self radicalization result. Okay, so let me explain this. Okay, so I'm going to have our guy Iggy meet two new people one of whom will call Jay. Okay, so this is so Jay has one of these models. Jay has a pretty skeptical model. If Iggy meets Jay, Iggy is going to update and adopt Jay's model, and Jay's model is going to make Iggy more skeptical. And in particular, it's going to leave Iggy with a posterior probability of the FDA being trustworthy of 0.37. Okay. Now, there's also someone else. There's someone else that Iggy could have met. I'll call that person Kim. Kim has this model. So again, Kim has a more negative model about what happens if the FDA is trustworthy. Like Kim thinks the action efficacy would be really very low. Notice that this is the kind of model that if this is the first model you come across, you actually ignore it, because this 0.47 is a bad explanation for why the friend is alive. And so you dismiss this model, right? You say this can't be the truth because it's just not persuasive of the fact that I do in fact see my friend alive. But the threat here is that Iggy first meets Jay, updates to this posterior 0.37, and then having updated some other way, then now when Iggy meets Kim, because Iggy regards the OWL state, the FDA trustworthy state, is unlikely, this 0.47 starts to matter less. And so Kim's model is actually persuasive if confronted second after this intermediate update. And I actually think this sort of fits quite well to one sort of view we often have in the data, which is you don't sort of radicalize all at once. You go through little steps where you're slowly you convince yourself of this. In this case, more and more crazy thing. I'm drifting more and more far from the truth. And so this is a genuine question that I think is which model is the right model of social learning? Do we have these intermediate updating of beliefs, or do we not? And I find it hard to have a very strong feeling about that. Now, having seen that this intermediate updating matters, we can actually go one step further and say that we don't even need to meet these crazy people along the way. I can actually just self-radicalize myself. So let's go all back to Iggy. Iggy isn't meeting anyone at all. This is again Iggy's initial reaction, which unfortunately is one which is sort of pretty negative on the FDA. So Iggy takes this initial reaction, as you've already seen. This initial reaction leads Iggy to update his probability that the FDA is trustworthy down from 0.5 to 0.4. But again, if we're doing this thing of like using the intermediate belief, right, I can take this posterior 0.4, and then I can stick with the same model and run the same exercise again. And when we run it the second time, now because I'm putting more weight on the 0.9 than the 0.6, when we run it the second time, even though I'm sticking now with the same model, my belief that the FDA is trustworthy has dropped from 0.4 down to 0.31. And we can keep on going. We can take the 0.31, plug it in again, and we get down to 0.23. And you see where this is going. And it's actually a very easy piece of algebra to see that if we iterate through this, we're just going to sort of end up with the maximally negative beliefs that the FDA is in fact completely untrustworthy for sure. So this I call this self-radicalization. This is I come up with this slightly messed up belief to start with. And if I just run it, doesn't even need to be as extreme as the one I've adopted here. If I just run it again and again and again, I'm going to convince myself that based on really no evidence at all, that the FDA is for sure untrustworthy. Final thing I want to touch on. I'm not going to have a chance to go through this in full. Is that so forget about this intermediate updating of beliefs now. Let me say something else to finish. The thing that makes this anti-echo chamber result in the paper work is these models in which the friend is alive no matter whether we're in state L or R. These models are very attractive, right? So these models explain the data, friend is alive, very well, and they also lead to very little updating. And more than anything, this is what's pushing against this anti-echo chamber result. But you might worry that these models, while they explain this individual piece of data, friend is alive very well, these models also imply just a very high survival rate. So we can imagine we live in a world where I see both friend is alive, but I do have some hazy understanding that I have to explain the fact that in my example, maybe 25% of people are dead. And you might think that aggregate piece of data should be disciplining exactly what class of models I can adopt. And if you add in that constraint, so that would be what adding in that constraint looks like, that would prevent the adoption of these uninformative models in which I've just made both these probabilities very high, and other things equal are going to push against, we're going to sort of make the echo chamber more likely and the anti-echo chamber result less likely, because they're going to make it harder to adopt these models. Now, I should say that the problem then is that because Adi has, I think, very reasonably updating on exactly this number, namely, which basically is what is the probability of the friend being alive, which turns out to be exactly the same as the aggregate fatality rate, it's now not clear how to choose among models. So I try to think about this a little bit. I should say I didn't really come up with a very good answer. There's a partial answer on a slide I'm going to have to skip, but let me not say any more about that. So I think I sort of believe adding in this constraint, but it leads to a little bit of a dead end, which I couldn't work out how to get out of, but maybe Adi and Josh can, which is, so once I've imposed this, how do I choose among different models? Okay, so I'd leave that as an open question. Okay, so I'm out of time, so I better finish. So again, this is a very nice paper. It analyzes social learning. I think this is obviously like a very important question. In particular, I think this question of do we or do we not live in a world where echo chambers form very easily and lead us to have crazy beliefs, I think is a topic of some obvious contemporary importance. This is a very rich model. Adi has this very nice baseline result, which I would describe as this social learning does not by itself lead to the echo chamber. I think the economics behind this result, I hope are now very clear. So broadly is that sort of overfit models are attractive, but the overfit models blunt updating and hence avoid this sort of echo chamber result. It's a nice result in the sense that it's persuasive after the fact, but not something which I clearly thought through of before reading the paper. And the main thing I'd just say is that I think this is a very rich framework, and there's also scope to sort of push perturbations of this further, because I think perturbations also explain circumstances in which we do in fact see things that look more like echo chambers or even self-radicalization. Yep, so thanks a lot.